What are real estate contingencies and how do they impact you? I know there is so much realtor lingo and buzzwords floating around, but contingency is not one of them. It is so important that you understand the 3 common contingencies that make up a majority of your purchase contract. Especially if you're in a hot market, I want to make sure you understand the potential ramifications of waiving those contingencies to strengthen your offer. We're going to walk through each of them today, and we're starting now. Hey everyone, welcome back to my channel. I'm Erica Monroe. I'm a realtor in the Bay Area and I specialize in Solano County. Today I'm going to walk you through the 3 common contingencies that make up a majority of your purchase contract. So what is a contingency? A contingency is a protection set into place into the contract to help protect you as the buyer as well as your earnest money deposit. If you didn't catch my video last week, there's a card available above. I go into more detail about an earnest money or good faith deposit. The earnest money or good faith deposit is your skin in the game. In Solano County, as I mentioned, we commonly see between 2 and 3% of the purchase price, so it's a significant amount of money. These contingencies are put into place to help protect that, because if they are waived and you default on the contract, the seller can potentially come after that deposit as liquidated damages, and that could take you out of the running to purchase a home. Let's chat through each contingency and I'll remind you what to keep in mind if you are waiving this as part of your offer. The first contingency or protection period is your inspection or investigation contingency. This is put into place to allow you time to inspect the property. Typically, you hire professionals to do a home inspection, pest, termite, and a roof inspection. It allows you to investigate the neighborhood to ensure that you really do want to move to that location. You're also presented with seller disclosures, where a seller is required by law to tell you everything they know about the home that may deter you from purchasing it or may impact value. That's called a material fact. The California Association of Realtor contract defaults to a 30-day close and defaults to a 17-day inspection or investigation period. Well, as we've discussed, this is a really hot market and a 30-day close isn't that competitive. So more often than not, we're starting to see a 21-day close. So for an inspection investigation period, you can anticipate maybe 10 to 12 days to investigate the property. This contingency allows you essentially a get out of free jail card. If you decide you're not really thrilled about the neighborhood, maybe you find out from the natural hazard disclosure that the house sits on top of a fault, you can cancel and still get your earnest money or good faith deposit back. You walk away unscathed. The only money you've spent is on inspection. Now, if you have waived your inspection period, you can no longer cancel without jeopardizing your earnest money deposit for the condition of home, location, anything other than what's protected by your other contingencies if you have those intact. The seller can come after that deposit as liquidated damages. They've taken the home off the market for you because you intended to purchase the house. You waived this contingency saying you were comfortable with the condition of home and location, etc. The seller now wants to reclaim their losses by coming after that deposit for liquidated damages. In today's market, it's pretty common for sellers to provide seller disclosures prior to setting an offer due date. The idea is that they want to encourage buyers to understand the condition of their home prior to making an offer. So essentially, write your offer accordingly to what we've disclosed. It's very rare that a seller would then come back and offer you any sort of seller credit for these early disclosures. Although this can be a risk, I have to acknowledge that sometimes this is what it takes to get your offer accepted. I would just stress that you make sure that you are comfortable making the decision and nobody is pressuring you. Moving on to contingency number 2, which is your appraisal contingency. Anytime there's a loan at play, and most buyers do have to acquire financing, a lender will hire a third party to appraise the value of the home. The appraiser will walk through the house, they'll note the condition of home, any upgrades, and also how it compares to other homes that have sold recently, or comps. I want to drive home the fact that the appraisal is one person's opinion of value. That is the value that the bank or lender will utilize for your loan. So for example, if you offer $500,000 on a house, but it only appraises for $490,000, the bank will only loan you up to $490,000. They want to ensure that the value meets or exceeds your purchase price. If your appraisal contingency is still intact, you have a few different options to proceed. Let's take that same example as before. You offered $500,000 for a house, but the appraisal came in at $490,000. You can A, make up the difference and pay that additional $10,000 out of pocket. B, you can go to the seller and try to negotiate and say, Mr. or Miss Seller, the house is clearly not worth $500,000. We don't have the cash to make up the difference. Can you please come down in price? Again, in today's market, it's probably pretty unlikely that the seller would come down that far, but you may be able to negotiate and split part way. Your last option with the contingency in place would be to cancel. If you and the seller cannot come to a negotiation, or you just don't feel that the value is there, you can still cancel and get your earnest money deposit back, walking away unscathed except for the money you paid on the appraisal. In today's market, it's actually not that uncommon to have a discrepancy between the appraisal value and the purchase price because we're in an appreciating market with very little inventory. Typically, the market value, what a willing and able buyer will pay for the house, is higher than what an appraiser would assign to value. An appraiser is usually comps recently sold homes within the last 3 to 6 months. Because we're in an appreciating market, value continues to rise. If you happen to have a low appraisal, are you going to be able to make up the difference to get to the purchase price? If you waive that contingency, you are telling the seller, I don't care what it appraises for, I will give you that price point. If you cannot do so and your contingency is removed, you are potentially jeopardizing that earnest money deposit. In certain markets, it may just not be realistic to be able to retain these contingencies. So if you are toying with the idea of removing your appraisal contingency, make sure you have an in-depth conversation with your realtor. Make sure that there's enough evidence in the market to support a high enough purchase price that you feel confident that you can make up the difference should there be a discrepancy. The third common contingency is your loan contingency. Most buyers need to acquire financing and they get a pre-approval letter in order to present the offer. The pre-approval isn't a full approval. The lenders just reviewed your income, your assets, your tax returns, but the file still has to go to underwriting, and the underwriter looks through all the documentation to ensure that you actually meet the loan guidelines. So what does it mean to remove that loan contingency? Some lenders will go ahead and fully underwrite their buyers before making an offer, and that allows them to remove the loan contingency. Having the lender fully underwrite your file is a great way to strengthen your offer. You will absolutely stand apart from another similar offer that has their loan contingency in place. However, keep in mind, even though you're fully underwritten, you still run the risk of potentially not qualifying if, for example, you lose your employment or there's an unexpected expense. It's unlikely that that would happen, but it's important to acknowledge that it could happen. And by removing that contingency, you are making yourself a little more vulnerable and potentially jeopardizing that earnest money deposit. These contingencies are written in to protect you, but understandably in today's market, you may have to consider releasing some or all. Just make sure you're really comfortable with the potential ramifications of defaulting on the contract and not having the safety net of those contingencies. If you need a more thorough overview of the process of closing or would like an example step-by-step 21-day close, check out this video. It'll walk you through from start to finish what to expect during the closing process. Thank you so much for watching. Please like, comment, subscribe, ding that little bell, and you'll get notifications as soon as I post my next video.